Good afternoon, everyone. Hopefully everybody's having a great day and Happy New Year to you. Welcome to When Can I Retire? Planning for the Big Day. A little bit of a disclaimer before we get started here is all of the information that we talk about today is purely informational, not meant to be tax or legal advice. So please talk to your licensed professionals before taking action. A little bit of information about myself. My name is Josh Strittmatter, and I am a continuing education instructor here at UTA. And I've taught classes at UTA since 2010. I'm also a financial planner by day, and I have my own financial planning firm called Strittmatter Wealth Management Group. Been an advisor since 2003. I'm a certified financial planner as well as a certified retirement counselor. And so looking at today's presentation, we've got a lot of great information today, folks. I think you're really going to enjoy it. We're going to talk about the steps to retire, and then we're going to go through several different topics around retirement today, ultimately to help you to determine when you can retire. So these are some of the things that we'll look at, looking at net worth and cash flow statements, talking about a retirement budget, determining a deficit, determining time to save, and then determine the date. Okay, so what happens when you retire? Well, something interesting happens, and it's interesting how people think about this. I've worked with people for many years, but they go from an accumulation phase where they're saving money to where they're actually taking money off of their savings. And for a lot of people, that is just a scary thing to think about, where you're withdrawing from your savings, something you've been saving to your whole life, essentially. Now you're drawing off of it. So what retirement is all about is generating income off of the assets that you have, and then the income that you're going to draw from your other sources. So Social Security, pensions, things like that. So we're going to spend a lot of time talking about that today. Here are the 4 steps to developing your strategy. First of all, preparing for the unexpected is very important. And there are several key risks to you, the retiree. One of them is longevity risk. Longevity risk is the risk of living too long. I know that sounds kind of ridiculous, but living a long life just means you're going to need more money. And so what you need to be able to answer is that question of, well, how long do I expect to live when you're talking about retirement planning? Because that's how long you need your money to last. And you can look at probability today. This is based off of the Society of Actuaries back in 2019. They looked at people, married couples, age 85, people who were age 85, they had a 83% chance living to age 85. There we go. If it was a male, it was 53% chance of living to age 85, 64% chance. For age 90, 33% chance for a male, 44% chance for a female, but a 62% chance that one member of that couple would live to age 90. And that's incredible, folks, from where we've been, by the way. So it just means that you need to be prepared for a long retirement. And even beyond that, age 95, a 34% chance that one member would live to that age. So again, planning for a long life means planning for a long retirement. And that's something that you should focus on. Another key risk is inflation risk. And so inflation risk is loss of purchasing power. And purchasing power is what we need to get through retirement. And so inflation is the key word here. And all of us have seen this in the news here lately, but inflation has really ramped up in just the last few months. This shows you what the effect of a 3% annual inflation rate does to you on a bag of groceries. So what you can buy today for $50, in 30 years would require $121 to buy that same bag of groceries. You can look at that the opposite way, which is how it affects your portfolio. And if I have $1 million today in my portfolio at a 3% annual inflation rate, that will be worth $411,000 30 years from now. So it has a huge effect on your overall cost of living and your retirement. And so what that means for you is you just need to plan for inflation. And we're going to talk about how you can do that today. Another key risk is the rising cost of healthcare. We've seen that over the years, not only for the cost of healthcare, but for long-term care. And you can see in 2019, healthcare costs well, and actually $301,000 in 2019 was the average cost needed to cover the health expenses in retirement. And these are just the rising costs over time compared to general inflation. And so you can see back in 2019, it almost was double. Well, it was double the cost of general inflation. So again, because that's such a huge cost to you as a retiree, it's something you need to be planning for. This looks at a risk of personal health crisis. And so what I define as a personal health crisis for a lot of retirees is a long-term care event. Let me define what that means. A long-term care event is where you can't do what are called activities of daily living. That's eating, bathing, transferring, just a list of different things that you're not able to do on your own, or if you're cognitively disabled. And so the problem with long-term care is the cost of it is just outrageous, folks. And it can really cause a big dent in a retirement for a married couple or even a single person, obviously. And so looking at this, this is looking at a $750,000 initial portfolio. They're withdrawing $45,000 per year and inflating that at 3% per year and achieving a 5% annual growth rate on the portfolio. You can see here that that money would last until around age 86 for this couple if they didn't have any crisis. But if they had a crisis, and this is defined as a $278,000 long-term care crisis, that would greatly reduce the longevity of their assets. So they would essentially run out of money at around age 70, 77, 76, somewhere in that time frame. So again, planning for health crisis is also very important in retirement. And again, that is long-term care. You also have the risk of unpredictability of the financial markets. This looks at the S&P 500 over different ranges of time. You can see here the cumulative rate of return from 1995 to 1999 was 250%, but from 2005 to 2009, only 2%, and then 2015 to 2019, 74%. So what that tells you is that the markets may not produce the returns that you want to achieve. Further, what this tells me as an investor that, you know, a lot of people use the S&P 500 as a tool to invest into because it has they view it as the overall market. But the reality is the S&P 500 is just the 500 largest US-based companies. So it's one sector in many different sectors. And so what I would tell you is that a diversified portfolio helps you to reduce the risk of not making the money that you need to make. The argument against that has been that the S&P 500 has been the leading asset class for the last decade. And it's a logical argument, but I remember back in 2008 when it dropped 40%. And so you just have to think about the stock market in longer periods of time and realize that a diversified portfolio is a less risky way to invest. Something else to consider is this, what are called sequence of returns risk. Sequence of returns risk looks at how your portfolio performs as you're withdrawing money from it and how that withdrawal affects your overall ending balance. And this can be detrimental, as this chart shows you. This shows an example of a $35,000 annual withdrawal from a portfolio that began at $500,000. And then there's two basically sequence of returns here. You have one that has early losses. So it starts off losing money, and then it begins to gain money in the latter years. Then you have just the opposite. So the mirror opposite of this is this portfolio investor B makes 14% and makes great returns in the beginning, but then poor performance in the end. And again, because this portfolio is being withdrawn from, when you have withdrawals from a negative year from your portfolio, that can have a pretty big effect on the overall longevity of that portfolio. So the ending difference between these two is 485,000 versus 337,000. So that risk is important to know about and to have a strategy for how you're going to address it. And we're going to talk about a strategy for how to address sequence of returns risk. By the way, as we go along today, you are welcome to ask any questions. I've got the chat feature up on my screen here. So if you have a question, feel free to just type it into the chat bar. I'll also be taking questions at the end. And so be sure and ask as many questions as you like today, folks, because a lot of people are probably thinking the same thing as you are. Step 2 is to envision your retirement. So now that you've understood the risks to you as a retiree, and you begin to think about how you can address those risks, what you need to do next is envision your retirement. So think about exactly what you'd like to achieve. So how do you want to spend your life in retirement? How will you support your desired lifestyle? And what will you do to accumulate if you haven't accumulated enough? And what a lot of people, what a lot of experts will tell you is that you may need 70 to 80% of your pre-retirement income to maintain your lifestyle. And I would tell you over the years, I've seen that to hold true. And a lot of that is because you quit saving money, your taxes go way down, you don't pay FICA taxes anymore. So just some cost savings occur once you're retired. So you should be using that number to plan with, unless you plan on increasing your lifestyle in retirement. Sources of retirement income. When we talk about retirement income, we talk about the three-legged income stool. So think about a stool that has 3 legs to it. The first leg of that stool is your personal savings and investments. The second leg is Social Security, and the third leg is your continued employment earnings. Let's go through each of those together, starting off with your personal savings and investments. When you have saved money for retirement, you're often using different saving buckets to save to. And so your first bucket are the tax advantage vehicles. These are typically what people will save to, the employer-sponsored retirement plans. So things like your 401ks, 403bs, 457 plans, IRAs to save personally, and then annuities also to save personally are also retirement vehicles as well. Those give you some great tax advantages as well as some liability protection. So those are great tools to save for retirement. You also have other investments that you can save to as well. So I think about a brokerage account, sometimes called just a taxable account. And these are where you can buy mutual funds, stocks, bonds, things like that. You also have your CDs and bank savings accounts, and then other non-tax advantage investments as well. And folks, it looks like my chart got a little messed up, so I apologize about that, but this shows you Social Security benefits. And this is the eligibility chart, essentially. It's a little bit hard to read because it's kind of messed up, but for a lot of people who haven't retired yet today, they were born after 1960, the full retirement age is 67. So this is when you are eligible to receive your full benefits. If you retire before then, you can start taking benefits as early as age 62. What happens is you get a reduced amount. So you only get 70% of what your full retirement benefit would be. So a 30% reduction. You can also delay taking benefits all the way to age 70. And if you delay taking benefits to age 70, you get what are called delayed retirement credits. Delayed retirement credits are 8% per year. And so in this case, you get 124% of your full retirement age benefit, the amount that you'd receive at age 67, you get 24% more. So when you're trying to determine when you want to retire, you need to think about how you're going to draw Social Security. And again, you can take it as early as age 62, but you're penalized because of it. But you can also delay it to age 70, and you will benefit from delaying it. This chart shows you the different amounts based on a $2,000 primary insurance amount. Primary insurance amount is the full retirement benefit at the full retirement age, which in this case is age 67 for this example. So if this person started benefits at as early as age 62, their eligible time frame to take it, they'd only receive $1,400. Again, 70%. But if they delay it all the way to 70, they'd get that 24% increase. So that what this illustrates is that every year you delay it, you get a little bit more, but it caps when you reach the age of 70. There's no more delayed retirement credits. One other thing to think about too with Social Security before I move on is that if you begin your benefits before your full retirement age and you continue to work, if you make over a certain dollar amount, they may reduce your benefits. So that's important to realize that if you're planning on continuing to working, they may reduce your benefits, and that may reduce the benefit to you to where you may want to just delay it anyway. And then continued employment earnings. So what's interesting about today is that we have really become a gig society, or a gig economy, I should say, so that many people can actually work from their computers and earn an income as a contractor. And I've referenced on my webinar several times a website that we use all the time called upwork.com, upwork.com. I'm not affiliated with them, but we use them all the time because we can find contractors same day. And so again, it's never been easier to work in retirement. However, when they've done studies on this, and they looked at what are people's wantingness to work versus what actually happens, you can see here that many people plan to continue to work, 80%, but only 28% of retirees actually do work. And so that's something to keep in mind as you're planning for retirement and you have that plan. Okay, well, I'll just continue to work. You need to think about, what is your ability to do that? So what is your workforce allow for that? Will they allow somebody who is retired to continue to work part-time? Whether it be reduced pay? Are you able to work online and continue to make money via the gig economy? So those are some important things to think about when you're thinking about retiring and trying to make money. So those are your incomes that you will be looking forward to in retirement. Now let's talk about refining your investment mix. And, we talk about investments regarding retirement because it has such a huge effect on your retirement, and how you invest makes a big difference on how much money you're going to live off of and how long that money is going to last. So it's very important to make sure that you get your strategy correct. And so we're going to talk about some ideas today to help you begin to formulate a strategy. And if you have further questions, you're welcome to talk to me as well. But the first thing you want to do is define your objectives. Second, define the time frame, and then third is look at your risk tolerance. Let's explore all of those. So in defining your objective, you want to basically say, okay, I want to live off this amount of money for this amount of time, and how much money do I need to achieve that? And further, what's my rate of return to make sure that I don't run out of money? Based off of that, you can then create a portfolio that will achieve that result. And so the first place that we start as professional investors is looking at the asset allocation. Asset allocation is based on some research that was done a few years ago. It showed and defined what was an efficient mix of assets for an investor based on their risk tolerance and time horizon. And so this looks at both of those things, and it defines an optimal allocation for different investment asset classes. And so this is a couple of examples of two different risk tolerances and allocations based off of the time horizon and risk tolerance. And you can see here that the first one is the conservative portfolio. So it has 20% cash, 30% stocks, 50% bonds. The second one is much more aggressive. So it's a 75% stocks, 20% bonds, 5% cash. And you can look at the performance of this. And by the way, they're going off of these are indices. So the S&P 500 index here, and then a limit or aggregate bond index, and then just a cash index. And so what you can see here is that while the conservative portfolio had years that were less aggressive or didn't perform as well, they indeed had an average annual rate of return because they lost less over that same time frame. So 5.49, 5.93, very close to being the same here. And so what that tells you, folks, is that, a lot of people think that I've got to invest aggressively to make up what I'm losing, but you also have to think about the downside protection as well, because you can lose a lot of money quickly when you invest into equities. So again, defining risk tolerance, defining your time horizon helps you to create your asset allocation. And this is, by the way, this is done through software. So it's not something that I generate as an investment advisor from my head. It's done through software. And we just plug in the data and it creates that proper investment mix. Once it's created that mix, you then have to invest the money. So these are some of the much broader categories: cash, bonds, stocks, mutual funds, and ETFs. And you also have to think about taxes as well. And so taxes are a large part of what we do when we do financial planning, because there's such a huge expense to you as the retiree. So it's important to know how taxes work. And I'll just go give you a brief overview today, but it really is to your benefit to understand how taxes work. So essentially we have income taxes, and those are based on marginal rates, anywhere from 10 to 37%. And that's what is taxed on, or that's the rate that's used to tax bond interest, rents, royalties, wages, short-term capital gains. Also, a portion of Social Security is taxable to you. Withdrawals from tax-deferred accounts are taxed at ordinary income tax rates as well, and then as pensions will be taxed at ordinary income also. Then you have qualified dividends and long-term capital gains tax rates. These are for taxable accounts, so these are not for retirement accounts like IRAs or 401ks. These don't apply to those type of accounts, only taxable accounts. And so you can see here, these are preferred rates. And so we play a lot in these preferred rates to help manipulate and reduce the taxes of clients that we work with. You can too. You just need to know how to do it. And it's just looking at timing of how long you hold an investment. In other words, to achieve a long-term capital gain, you have to hold it for longer than 12 months. If you don't hold it for longer than 12 months and you sell it, and it's got a gain, you're going to pay ordinary income tax rates. So again, knowing the rules is important. Also paying attention to tax exempt rates as well. Tax exempt bonds are municipal bonds. Roth IRA is tax-free growth. So taking advantage of every opportunity that you can reduce tax is to your advantage as the investor. And it helps in basically creating a greater rate of return over time. Looking at some income producing vehicles, you have fixed income investments, income oriented mutual funds and ETFs, dividend paying stock, tax exempt investments, and then income and annuities. Let's talk about each of these. So a fixed income investment is basically a bond. A bond is essentially a liability that, if you're the investor, you loan money to a corporation or to a government. In exchange for loaning them money, they're going to pay you interest, and that's a fixed rate interest. And then upon maturity of that loan, could be a 1-year loan, could be a 30-year loan, it just depends on the bond that you purchase, you'll get your principal back. So one of the unique things about bonds is that you get a nice fixed rate of interest that doesn't change, and your principal back upon the maturity of that bond. So some people will use bonds to create income portfolios. Now, here's what I would tell you about this right now is that because we're in such a low interest rate environment, it's really difficult to do today. Whereas 10, 15 years ago, we did a lot of it. Today, we don't do a whole lot of this. But just to explain this concept to you so that you understand it, because in the future, as interest rates go up, this will come back into vogue, and we will do this again. A bond ladder is where you buy different maturity bonds. And so I might buy a bond that matures in 2 years, one that matures in 4 years, one that matures in 6 years. What happens is I'm paid interest from all of these bonds, but liquidity becomes available to me at each maturity date. What that allows me to do is to reinvest that money, hopefully at a higher rate. And we are in a rising interest rate environment, so that would be a pretty good bet. But in doing so, I can keep rolling this ladder and achieving hopefully a higher rate in doing so. And so that also spreads the risk around. If I own 5 different corporation bonds, now if one corporation goes out of business, I don't lose all of my money. I only lose 1/5 of my money. So it has several benefits to you, the investor, but this is a way to create a fixed income diversified strategy using bonds. And we can also look at dividend paying stocks. Dividend paying stocks are companies that will pay out a portion of their earnings to you, the investor, when you own the stock. And in doing so, you can have some great benefits. Number one is a money to live off of. It's typically paid semi-annually or quarterly. And then you can also have a lower tax rate. So if it's a qualified dividend, which looks at how long you held the investment, and it being a US-based company, that qualified dividend would be taxed at a lower tax rate than ordinary income tax rates. It's that 0, 15, and 20% tax rate. So for a lot of people who want to use a dividend portfolio to pay themselves in retirement, it also can provide some great benefits for tax purposes as well. So again, I'm not sure what happened to all my charts, but this one got screwed up too. But this talks about looking at whether or not tax-exempt investing is appropriate for you. So let me give you some background on that. When you're looking at tax-exempt investing, you're basically comparing a corporate bond to a municipal bond. So a corporate bond is put out by a corporation, and it's taxed at ordinary income tax rates on the interest that's paid to you. Compare that to a municipal bond. Municipal bond is issued by a municipality. And what's unique about a municipal bond is that you don't pay tax on the interest from a municipal bond. But because of that, they pay you less interest because they know that you don't have to pay tax on it. They're going to pay you less interest. But so when you're the investor are comparing these different types of bonds, you're essentially comparing two equivalent credit ratings. So two bonds that have the same credit rating, same term, same maturity. And you're looking to see which one pays you the most based on your tax rate. And so you have to find the tax equivalent yield to do so. And so if you're in a high tax bracket, if you make a lot of money, taxable income, that's where municipal bonds oftentimes will make sense. If you're a low income tax bracket though, that's where a corporate bond, a taxable bond would make more sense to you. So again, it's important to pay attention to which types of investments that you're using so that you can minimize the taxes that you're paying. Many people in the past have had pensions that they've been able to draw off of for the remainder of their life. Both of my grandfathers had pensions. They were both Lockheed employees. It used to be General Dynamics back when they were working there. And they were lucky enough to have that pension that paid them until their death. Today, you just don't see many pensions around anymore. And so that benefit of having a guaranteed income stream for many people has gone away. And so for people who like that benefit of having a lifetime income, they can replicate it using an annuity. Pension is nothing more than an annuity. And so an annuity basically allows you to pay into an investment and either today, which is called an immediate annuity, convert that to an income stream for life, or defer that until the future date where you can then convert it to an income stream. That allows you to continue to save into it until you're ready for that income. So these are two strategies that people will use who want to have a guaranteed income stream. And as people are living longer, this may be an effective strategy to make sure that they have enough money and that they don't outlive their money. This gives you an example of an immediate annuity where $100,000 is invested today, 3.5% return, payout over 20 years is $7,036 per year, or $586 per month. And then a portion of that is taxable. And that's another advantage of an annuity is it has some tax benefits as well. Only $2,000 of this is taxable to you. So again, this is a 20-year payout annuity, but there are also lifetime payout annuities that can make sure that if you're still alive, that money's being paid out to you. And then choosing a distribution method for tapping assets is very important. And this is where we get a little technical, but I'm going to share with you some great ideas for you. This looks at how long would a retirement portfolio last based on distribution rates. We have a 4% distribution rate and an 8% distribution rate. This is a $500,000 tax deferred account, $50,000 inflation adjusted withdrawal at 3%. You can see here, if you're withdrawing 8%, that money would only last about 14 years. Excuse me, you know what? This is different rates of return. I got that wrong, I'm sorry. 4% rate of return versus 8% rate of return. Yeah, I got that one wrong, folks. So 4% rate of return would only last 11 years, 8% would only last 14%, or 14 years rather. So the takeaway from this slide is that when you're looking at investing for retirement, if you are barely beating inflation, you won't make a lot of money. you have to invest your money to beat inflation and to go beyond inflation if you expect your money to last. And so we'll talk about distribution rates in just a minute. But the main point of this slide is that you have to invest for the long term. One of the things I always counsel people on is that there are investments that are guaranteed to lose you money. And they're surprised by my answer when I tell them. The answer is savings accounts, CDs, checking accounts, low-paying bonds, low-interest paying bonds. When you do not beat inflation, you are actually losing money. So when you look at what's called the real rate of return, after you factored in inflation, you would have lost money in those type of investments. A lot of the people, when I first got into the industry, who were from my grandparents' generation, that's how they invested. They lived through the Great Depression, and they didn't like losing money. And so many of them saved into savings accounts, CDs, but unfortunately for the last 30 years, they saw interest rates dropping and inflation rising. And so because of that, many of them ran out of money. So don't invest into investments that lose you money is rule number one in investing. But also keep in mind that you have to stay invested once you're retired. You can't just pull it all and put it in cash. You have to stay invested. Let's now talk about drawing down your assets. And so keep in mind, I'm about to explain 3 different strategies here, folks, but there's no perfect strategy. It's what your preference is. Here are the 3 different things to think about. So when you're making decisions on this, the value of your portfolio, the actual investment returns, and the amount of the timing of withdrawals. These are the 3 different strategies: life expectancy, 4% rule, and 3-tiered strategy. Let's go through these each individually. So looking at a life expectancy method, this is where you have a life expectancy factor. And the IRS actually publishes life expectancy factors that you can use, because they do this for what are called required minimum distributions off of IRAs. This is how required minimum distributions are calculated. And it's based off of basically a increasing amount or increasing percentage so that you completely run out of money by the time of your life expectancy. I shouldn't say completely. It's pretty conservative, but it's meant to help you to run out of money. So in other words, use your money effectively before you pass away. And you can see here that the way that this works is you look at your life expectancy, and there's a factor. And essentially what you can do is divide your December 31st value by that factor. Each year that factor goes up a little bit. And in doing so, the amount, depending on how much gain you've had, can go up or go down. So again, life expectancy is looking at a factor based off of life expectancy, and that factor changes each year. And it's meant to help you to use that money before you pass away. Another key tool, I should say, is the 4% rule. 4% rule looks at withdrawing 4% from your portfolio each year. And so in this example, we have $1 million. The first year withdrawal is $40,000 or 4%. It also shows you 2 other withdrawals rates, 6% and 8%. And how quickly you run out of money when you withdraw at these higher percentage rates. So the 4% rule has been around for a long time, folks. It's based on some research that was done that was called the Trinity study. And it just looked at different portfolios and different withdrawal rates, and it looked for and it seeked the highest longevity of the portfolio based on the highest percentage withdrawal rate. And 4% was the consensus rate that was considered the safe withdrawal rate. So again, very simple. Just take that 4%, and that's what you're living off of. The 3-tiered strategy looks at tiering your portfolio, and that's based on how you invest in the risk tolerance. So tier 1 is basically short-term, 2 to 3 years, and that's invested in conservative assets. Tier 2 is 3 to 10 years, mostly fixed income assets like bonds. Tier 3 is the aggressive portfolio. So this is your stock portfolio. The benefit of this is that you can withdraw off of the short-term portfolio, which is invested very conservatively. in the first few years. And in doing so, you don't touch the more aggressive portfolio, the stock portfolio. And in doing so, that helps reduce that sequence of return risk that I mentioned earlier, in that you're not withdrawing off of a portfolio that's gone down. That can have an exponential effect on your portfolio. So another key rule is to not withdraw off of a portfolio that has lost value. And a way to do that is to tier your portfolio. So advantage of this is it can manage long-term strategy, or it's a manageable strategy, provides a way to balance current income against future growth. And then disadvantage, it requires active management. You have to pay attention to it each year. Depends on the market performance, and it may be challenging to coordinate. Here's an example of the three-tiered strategy. And this is something, this is along the lines, pretty much kind of what we do when we're building portfolios. So we put this in practice. It's tweaked a little bit differently, but this makes the point. So you see here an initial portfolio of 850,000, annual income goal of 45,000. You have the three different tiers. The first tier is the growth investment strategy. And the idea here is what they're going to do is they're going to lump sum the amount that's needed to, in the first case, in tier one, to pay 45,000 for the next 5 years until it's depleted. The second tier is only going to be a lump summed, making 4% in this example, so that after 5 years, it's 206,000, which is exactly what's needed to replace the first tier again. So after the first tier is depleted, the second tier kicks in and pays for the first tier. The third tier is the biggest bucket of money that's invested in, again, invested in stocks, in this case, earning 6%. That's invested for the next 10 years. And in doing so, after 10 years, making 6%, it's back up to 850,000, which you then replenish the other two buckets. And so it's a way to have a replenishment strategy, but also keeps an eye on risk so that you're not having to withdraw from equities to pay yourself in a down market. So it's a really smart way of building a portfolio, folks, is what I would tell you. And again, it helps you to do and solve a lot of the problems with retirement and as far as withdrawing money from your portfolio. Okay, let's move on and talk about identifying what to spend first. So when we talk about liquidating assets, excuse me, we think about it in two different ways. The first is looking at the taxation of it. So in this case, liquidating taxable assets before tax-deferred assets. What that allows me to do is get rid of those investments that are taxed annually for dividends or capital gains when I capitalize them, and deferring the money that is continuing to grow tax-deferred before I withdraw from it. Another way to look at it is looking at liquidating winners before losers. So if I've had an investment that has done fantastic for me this year, I'm going to sell off that investment and live off of that and let my losers regain or make back what they've lost. Another strategy is, well, I would say there's more strategies beyond this, but when you're looking at this, we're going to talk about some ideas in just a minute, but you need to be thinking about tax consequences and then opportunity cost. This is something that I talk quite a bit about, folks. This, especially around investing, is it's the money that you're not making when you're investing. And this is something that rarely gets talked about, but I give the example of, just last year, if you had been invested conservatively, S&P ended the year at 27%. So if you invested in something that made you 10%, if you invested conservatively, that's 17% that you didn't make. Now, on a large bucket of money, that's a lot of money. And so opportunity cost is indeed the money that you're not making, and you need to be aware of that as you invest. There's also emotional implications, and that's kind of the risk tolerance side of investing as well. We talk about, what is your ability to stomach a downturn in the economy and a downturn in your portfolio? And for some people, they lose sleep. And so if we need to be more aggressive, but they're going to lose sleep, oftentimes we'll go with a more conservative strategy because it's more important to be able to sleep and be healthy than to try to make a higher rate of return, I would say. When you are retiring and leaving a job, oftentimes you will have a workplace retirement plan, and that is a 401k plan, a 403b plan. And so you have some options for what to do with that money once you retire from that job. Sometimes you can keep it at your former employer, and that's if the plan allows for that. Many plans have stopped allowing for that though, and they require you to roll it out of their plan. So you just have to check with your plan administrator to determine that. Sometimes you can take a lump sum distribution, and essentially what that means is you take all the money out. The disadvantage of that is you pay tax on all the money. So many people don't do that unless they have some very specific reason of why they're doing it. You can also take systematic withdrawals where it just pays you out over a period of time. And then you can also choose a lifetime annuity in your plan, depending on the plan's ability to do that, to elect that. The other option is to roll it to your IRA. In an IRA, you have several key advantages over your workplace plan. At the workplace plan, you often have limited options that you can choose from to invest into, whereas an IRA, you have unlimited options to invest into. With the IRA owner, you are the owner of the account. With the 401k or 403b, 457, you're a participant. So they can make decisions for you. They can change investments without your consent. With an IRA, none of that happens. So many people will roll their retirement plans over to an IRA. And by the way, a lot of people ask about liability protection. You still have liability protection in IRAs, just as you do in a 401k. So there's a lot of key advantages to it. You need to keep in mind the cost differences between the two when you're making that decision as well. But just going through the pros and cons will help you to determine whether or not that would be to your advantage. Lifetime annuity payouts, again, this may be available to you based on having a pension or a retirement plan that offers a pension payout. This shows you, basically, there's two different main types of payouts from an annuity or a pension, and they're based upon who gets what. So the single life is basically a payout to you, the owner of that annuity, for the rest of your life. So it would pay out to the rest of your life. Upon your death, there's nothing left to a survivor. So no benefits go to a beneficiary. Compare that to a joint 100% survivor. That's where you can pay it out for the rest of your life, and then it goes to one of your beneficiaries for the rest of his or her life. So in this case, if they have different payout percentages, 100%, 50%. So 1175 is paid out to me for the rest of my life, and then if I pass away, 1175 paid out to my wife for the rest of her life. That's what the 100% is. She receives 100% of what I was receiving. 50%, 1,500 to me, 750 to my wife. So you're going to have to make a decision on which payout that you choose when you have an annuity payout or a pension payout. And that's something to take a look at along with your overall strategy for income. And realize there are some strategies that you can use for pension payouts. We don't get into them in this class, but I certainly teach them in other classes. So when you're looking at which distribution method is appropriate for you, you need to think about your age, your liquidity needs, market volatility versus preservation of funds, income needs, and tax situations. These are all things we've talked about today. We talked about rolling your IRA over and the benefits of rolling over the IRA. Something to consider is requirement of distributions as well. That has recently changed. When you turn age 72, used to be 7.5. And that's still in place if you turn 7.5 before 2020. But you have to start taking money out of your retirement plans, your IRAs, your workplace retirement plans. And that's based off of what's called the required minimum distribution. And as I mentioned earlier, that's based off of the IRS life expectancy tables that the IRS publishes each year. These are important to know about, folks, because if you don't take them, there's a 50% penalty on the amount that you should have withdrawn. So very important that you keep up with this and that you're aware of how they're calculated, because again, you can be penalized heavily if you don't, let's see here, if you don't take the money out. Roth IRA is a great way to withdraw money for retirement, and the great benefit of it is tax-free withdrawals. So you can contribute to a Roth IRA if you have a certain level, or if you're under a certain level of income. You can also do Roth conversions from pre-tax accounts. And in doing so, you'd pay tax today on that money that you convert, but it would then grow tax-free for the remainder of your life. Something that's unique to Roth IRAs is there are no required minimum distributions. So you can leave it in there until your death. And then if you're married, they can transfer over to their Roth IRA and can be invested until their death. It's not until it's passed on to a non-spouse beneficiary that the beneficiary rules apply for a 10-year payout. So again, a great tool. What we use this for, folks, is to help minimize taxes in retirement by paying attention to which buckets we withdraw from. And this is a great way to, if we're going to be over a tax bracket with the income needs, we have money in a Roth IRA, in order to not be taxed at that higher rate, we can withdraw from the Roth IRA to pay the investor. So folks, wrapping this up, can you retire today? If you have all your ducks in a row, is what I would say. And a lot of the things that we talked about today are things that you need to be thinking about and planning for your retirement. There's lots of information online these days on what we talked about today. This presentation, by the way, is recorded, and you can view it again on my website, strittmatterwealth.com. We have a whole library of webinars on there now that if you'd like to revisit some topics, you are welcome to go check those out. I also recommend that you sign up for more UTA classes, and you can do that through their website listed here. If you have questions about today's information, feel free to give me a call at that number listed there as well. And then if you would like to email me, you're welcome to email me as well. We will be sending everyone an email today that it has a free financial organizer as well as a link for free financial calculators. And so that's a great way to help begin to gather documents for yourself, complete your net worth statement, complete your cash flow statement, things we talked about earlier. So that's it, folks. I hope you've enjoyed this presentation today. Please give us a call if we can be of service in the future. And we look forward to seeing you at the next presentation, which is coming up very soon. And you can go to UTA's website to check that out as well. Other than that, thank you very much.